7:45. Welcome back to First Up this morning. Thank you so much for joining us this Tuesday morning. Right now we have in with us our friends from the Unit Trust Corporation to give us some sound financial advice. We have a long-standing friend, Justin Silva, portfolio manager, and also a newcomer to our set, Nicholas Chen. Gentlemen, good morning to both portfolio managers, by the way.
Good morning.
Hi,
Good
morning.
Thanks for joining us once again and updating us in the direction we should be looking for good financial advice. Today we're talking about financial statements.
Correct.
Generally. What's the significance of a company's financial statements?
Sure. Hi, morning Jesse, morning Paul. Thanks for having us. It's a pleasure being here. So financial statements. Okay, some financial statements provide some insight into the financial health of a company. So that's this critical decision making. The principal financial statements are the balance sheet, the income statement, and the statements of cash flows. So use of the financial statements are both internal and external stakeholders, such as lending institutions, employees, management, regulatory authorities, and the general public. So just to give an example, as an investor, we would look at a financial statement, dig through and determine the financial performance of a company before investing in a company. If you look at, for example, suppliers will look at the financial statements of a company before deciding if to sell merchandise on credit. So those are a couple of examples of how we use financial statements.
How can we tell, without as lay people, without training like you guys, how credible financial statements are? We've had so many instances where companies have posted healthy financial statements and people have made decisions based on those, only to end up on the wrong end of the financial stick, so to speak.
Correct. Well, I think it's important for Trinidadians, well, and even just the amateur as well as the avid investor, to get familiar with financial statements. Now, some people feel when they actually do look at financial statements, they more or less have this mental block to it. I would always say, take your time, look at it, get familiar with the financial statements. As Nick mentioned, there are 3 key financial statements, and the ideal method is to get familiar with their makeup. A financial statement is very much like an X-ray into a company, and you could really, when you look at a financial statement, you can see down to the bare bones of the company. It gives you an idea of not only as to the health of the company as say an X-ray would, but it will also give you an idea as to how the company is being managed.
What should we be zeroing in on with a mass of data?
Okay, great. Well, you know what? Let's talk about the actual financial statements, right? We brought some sample financial statements for our unit holders to look at. So let's look at the balance sheet first.
If we could bring those up, and while we're bringing them up on screens, we could talk about what we should be looking to identify in them.
Correct. Now, your average balance sheet, well, what our unit holders should be seeing on TV right now is a balance sheet by a demonstration company. Your balance sheet is called a balance sheet because it must balance. First, you will see on screen assets, and this is made up of your current and non-current assets. Your current assets are any resource used by a company that is expected to turn into cash or yield cash within a 12-month period. Non-current assets will be yielding cash within 12 months or more.
I don't know how clear that is now, but if we can...
We have something on screen. I'm seeing several headings: assets, liabilities, owner's equity, and totals for each of those. This is the basic balance sheet you're talking about.
Great. And we will always recommend to our viewers, when you are analyzing financial statements, always view financial statements over a period of at least 3 years, because this will allow you to see how the assets or the liabilities of a company have grown. The assets of a company, just to give our unit holders an idea of exactly what an asset is, these are the resources that a company will be using to actually run the business or to generate revenue from their operations. Liabilities and equity are those items which a company would use to actually fund those assets. So both of them are very important, and your liabilities and equity must always equal, liabilities plus equity must always equal total assets, which is why you call it a balance sheet.
So they must always balance out.
They must always balance out, and it's very important because if you look at it, we only have 1 year here for simplicity's sake just for today. But if you look at it over a period of time, you can see how your assets are growing, or you can see how your liabilities are growing. An example of a liability, for example, is a non-current liability will be, for example, a long-term loan. If you see that starting to grow over a period of time, then you have to ask yourself, well, why is this person or why is this company taking on excess liabilities to fund their business? Is it that they're not producing enough cash? Or maybe they're expanding, and okay, if they're expanding, how is that being managed?
Okay, so when your liabilities start growing more than your assets, you're overextending yourself, and you need to stop and check.
Correct. Well, not stop and check, but you need to ask yourself, are you really utilizing that, what we call leverage? Because like some of our unit holders might be familiar with the term leverage. When a company borrows, they're borrowing cash they don't have to increase their business or to increase the size of the business. That's called leveraging. And you have to ask yourself, okay, great, this money that you have borrowed, is it going to be invested into something which is going to increase your returns? Is it going to increase your revenue, your cash flows, and therefore benefit the company in the long run?
Nicholas Chen, how can we, let's draw an analogy from a company's financial health to someone's personal financial statement or health.
Okay, great. As Justin mentioned, with regards to the balance sheet, we could also use it on a personal basis. So I encourage everybody, as well as in line with financial planning and budgeting, to also set up a balance sheet on an annual basis, or even more regular as we see fit. So just like a company would set up a balance sheet with assets and liabilities, we could also do that. For example, assets, we'd have like our house, maybe land, other buildings, cars, appliances, computers, even investments at unit trust or cash in the bank. We can consider
so we should, so everything. So because sometimes we just think of the big things like the car and the house,
exactly,
and the land, so
exactly,
your computer, your possessions,
exactly,
valuable jewelry,
anything
exactly
that you have that could be turned into some sort of cash or that you know is some sort of value is an asset to you.
And what's beneficial as well is that if we do it on an annual basis, over the years we can see how like we've been responsible financially, and we can see our assets are growing. You know, our savings are increasing. We have more assets altogether. So yes, this is important.
It's an important part of the personal financial process and the personal budgeting process. As Nick said, you should be doing your personal asset. Your personal balance sheet. Some of our unit holders or viewers may be familiar with doing, when they apply for a loan, they are asked to actually do a small calculation where they calculate their net worth. In fact, what you're doing is your personal balance sheet. You add up all the assets that you have, and then you add up all the loans and outstanding obligations you have, and that is your personal balance sheet. Now, if you do that at the end of 1 year, and then you do it at the end of the following year, you could actually have draw a comparison to see, okay, great, my assets are growing. Your assets are directly linked to your wealth, and those will directly impact your personal income statement. For example, if you have investments at the Unit Trust Corporation, if you have a growth and income fund, that is also adds to your assets, and that gives you distributions, which augments your income. If your liabilities are growing, that means you're taking maybe loans, maybe an overdraft, something of that sort. Maybe you're investing in yourself and you're taking a loan to go back to school. But that will also feed into your income statement because that increases your expenses and you have to pay interest expense on that. So if you monitor this over a period of time, you could understand how to control your wealth, how to control your revenue and expenses.
We have an example of an income statement, I think, that we could put up on screen. And you kept mentioning it several times, income statement. That's basically how much money you have coming in,
yes,
whether it's money that you're earning or money from a loan or say something you inherited or something like that. Okay, so let's look at it. We're seeing
revenue.
Revenue.
Yes, so
expenses.
one way that we could, an analogy we could use to simply describe an income statement is a staircase. So we start at top of the staircase and we have our revenues, which is the income generated for the specific period of time. As you go down step by step, we will deduct our expenses, such as our cost of goods sold, our expenses such as advertising, bank charges, utilities, etc. And when we reach the bottom of the stairs, what we do is that we take total revenues minus the total expenses, and we have either net income or a net loss.
When you add this, actually, when you bring this back to the personal sphere, because this is a company financial statement, which is, of course, is very important because you want to know how profitable the company is you're looking at. But this could also be applied in the personal sense, and we want our viewers to understand that. Because if you also do this on a personal basis, at the end of the day, if you come up with a net income figure, personal net income figure, this is basically net resources you have available to yourself. And you can choose, okay, great, how do I maximize this net resources, or how do I use this to benefit myself? Do I invest it for my retirement, which I would definitely suggest they consider, or do I treat myself and my family to vacation?
When one is, and this may seem like a really naive question, when one is making up one's personal financial statement and a document of one's financial health to go to an institution, how important is honesty And it may seem like a naive question because people tend to hide stuff for whatever reasons they have, but it can come back to bite you in the behind.
Yeah, of course. It makes no sense, you know, not being true to yourself when you go through this process, because really it's for you. Financial independence is so important for every man, woman, and child. And to be honest to yourself and actually put down what your limitations are. Be honest to myself and be like, okay, great, this is my house, this is my car, these are my computers, these are my furniture, these are my assets, right? These are my investments. This is what I know, this is what constitutes my wealth. If I am honest and I look, okay, great, well, this is my obligations. These are the loans I have taken. This is the carnival loan I took last year. This is the loan I took for vacation. And if you're honest with yourself, you will see that, for example, a loan for consumable, like a carnival loan or a loan for vacation, would not add to your assets. It's really money that you are more or less burning up, for want of a better word. And when you are true to yourself and you actually go through that process in a truthful manner, you'll be able to realize that how important it is to do this, to manage your wealth.
Is there a red flag area that should tell us when we need to press brakes in terms of our assets versus our liabilities, in terms of a formula that we can apply? We have 1 minute, but we're going to take you over the news break to continue.
No problem.
So
I'll just mention that we hope that at the end of it you have a net income, which shows that you are living within your means. Because at the end of the day, as Justin mentioned, you also want to be financially responsible. You also want to be, at the end of the day, it's only going to benefit you. So you want to put aside savings for yourself for a rainy day, or you never know what's going to happen to you.
But at what point do you tell yourself, well, my assets and my liabilities are dead on equal, and maybe I should look at pulling back? Is there a formula that we should use, 10%, 15%?
The thing is that, well, of course, with respect to your income, just going to your income statement, you must always pay 10% of your income, or invest 10% of your income. Aim to have 10% of your income invested.
We're going to pause it there. We're going to come back with Nicholas Chen and Justin Silva, both portfolio managers at the UTC. More after the break.
It's just about 9 minutes after 8 o'clock here on First Up, the first stop in your busy Tuesday morning. We still have our friends from the Unit Trust in with us, Nicholas Chen and Justin Silva, portfolio managers at the UTC. And basically, they're walking us through the financial statements of companies and also paralleling how we should do our own personal financial statements for our private lives. And the bottom line is you need to make sure that things are balanced out, that your assets and your liabilities and your equity, that they all balance out, and you don't find yourself in an overextended position where you have to wonder, maybe I need to do some cutting back in some places. Right, Justin?
Very correct, very correct. And it's not so much maybe cutting back, but just looking where, okay, how am I funding my life and what am I buying with the funds that are available to me? Am I investing in items which are going to increase my wealth, or am I just throwing it down the drain? Which, of course, the latter is what you want to avoid. Yeah.
And Nicholas, how should financial statements help us in making better investment decisions?
Of course. I encourage everybody to, before buying a company's bond or stock, to look at the financial statements, look at where the company is growing. Maybe they're diversifying into different regions, look at ways they're cutting costs, increasing...
Should we look at a history?
Yes, exactly. Look at least, as Justin mentioned, look at least last 3 years, and if possible, go even further back.
What should be red flags?
Red flags, of course, would be in terms of what's happening in the environment. Look at how they perform in relation to their peers. So ideally, you want to invest in a company that's superior in terms of the industry average.
Let's just run an analogy. Apple versus BlackBerry.
Oh, you're self-serving.
Research in motion, not doing too well in the last couple of years, but touting a big phone coming up. Should we base our investment based on these kinds of promises that BlackBerry 10 is going to be great, it's going to revolutionize, or should we look at the track record in the past 2 years and compare it to Apple or Samsung?
It's important to do both. Of course, you look to see how well they performed in the past or how well they did not perform in the past, but also to look at what they're doing for the future in terms of, as you mentioned, innovation with the new operating system for BlackBerry. Look at what they're going to do to have a competitive advantage over their competitors. So yes, these are things, you're right. So to keep keep abreast of what's happening and to decide to make a good financial decision as to whether you're going to invest in this company or that company.
The financial statements could also give you an idea of how sustainable the company is. For example, taking the picture of Apple or BlackBerry. One thing you would want to see, okay, great, how are their sales growing? So how is their revenue from sales growing? Is it growing? You might see sales growing in one company and may not be growing in the other, and maybe shrinking. Another item that what I like to tell my colleagues is always identify for yourself key performance indicators, things that you like to look for in a company that can help you advise on their health. One of these items is the gross margin, and the gross margin is basically the difference between your gross revenue and your cost of sales. If this is increasing over a period of time, say 3 years, then you know, for example, the company is doing well, they're doing something to increase their sales, and they're possibly doing something to manage their costs. If it's shrinking, then you have to ask questions. Is it shrinking because sales are declining? Is it that people no longer want their product? Or is it because they're not managing their expenses? Maybe they're hiring too much people. And these are the kind of questions you have to ask yourself.
Translate that into your personal, the personal sphere.
In the personal sphere, it's the same thing. If you are not adding to your personal assets, if I take a loan to go on vacation, I am not adding to my assets. If, for example, if I borrow money to say to invest in a business, or even to invest in a stock that I know I will get a higher return on or expect, depending on my risk appetite.
Or a home improvement loan?
Or a home improvement loan, correct. That could augment my assets. Then I know that is good relative to the loss, because if I see my liabilities increasing over time and my assets aren't increasing over time, then I know there's going to be a mismatch, and you're going to see the difference between your personal assets and your personal liabilities is something you call net worth, which is something we're all familiar with. And if you see that net worth start to decline, then you have to stop and ask yourself, okay, I'm probably not managing my finances correctly. I'm not building my wealth correctly. Because when you don't do that, when you don't augment your assets, you will definitely see your income either decreasing or remaining the same, while your expenses are going to start increasing.
And just finally, just for added clarification, although we do a yearly assessment in terms of financial statement, we should certainly be looking at month-by-month budgeting to contribute to that being accurate.
Well, the thing is, you know, at least yearly, but it's something that should be revised on a regular basis, because you want to give yourself targets, at least every quarter. Review your personal budget. Am I on track to make the savings that I want to make at the end of the year?
Okay, gentlemen, thank you very much for being with us. We've been talking to Nicholas Chen and Justin Silver, both portfolio managers with the Unit Trust Corporation. You can get more information on our website or their website, utc.com. We take a short break and come back with our final segment here on First Step. Stay with us.
The older you are, the more likely you are to